Salient features of the company. So we must understand, what are the features of a company whenever we are preparing accounts for companies which are limited companies, okay, which are listed companies. So what are the features? It is an incorporated association. That means it is registered under the Companies Act. Okay, it is registered under statute. Fine, it's an incorporated association. It has a separate legal entity. Okay, so the company has its own legal entity apart from its shareholders or its directors. So it has its own legal existence. Okay, perpetual existence. So that means the company is going to be there till it wants to do business before it is wound up. Normally, the companies don't wound up unless it goes for liquidation or it has run into big problems. So we will presume that company has a perpetual existence. Then it has a common seal. So whenever it signs certain documents, a common seal has to be affixed on all the documents because it company has its own existence, so it needs to be having its own common seal. Then company has limited liability. So what does the word limited liability means? Anybody? If I say company has okay. Property can be absolute. That's the right, this thing. So limited liability is basically the shareholders who invest money in the company. They are only liable to the extent of money they have given to the company. If the company suffers losses, okay, then the shareholders will not be asked to bring in more money to meet out its liabilities. So whatever maximum they can lose is the money which they have invested. Unlike a sole proprietor or a partnership firm, their personal property can be dragged into the, whenever the company is in, whenever partnership firm or a sole proprietorship firm is in bad situation, it goes insolvent, then the liability of the partners is not only limited to what they have brought into the business, but apart from that, their personal property can be sold to pay off the debts of the company. But in case of company, it is not so. Okay, so that's one of the biggest advantage that the company shareholders, they have only liability to the extent what they have put the money into the business, and their stake, they can only lose that, nothing more. Okay. Then distinction between ownership and management. Okay, so the owners are basically the owners are the shareholders, and the managements are basically the agents who are working for the shareholders and who are running the company. Okay, so there is a distinction between the ownership, the shareholders, and the management. The management team is responsible for carrying out the business, and they are appointed by the shareholders. Okay, in form of directors or in form of managing directors, or all the people who are working the company, they are the management group. Okay. Transferability of shares. Now, shares can be transferred in case of a company. Okay, anybody like in case of a listed company, people can sell shares in the market. Okay, so they don't have to even ask the company. They switch over from one company to another company. It can be easily done. So, which is not the case in case of any other form of organization. Maintenance of books. So, all the companies are required to maintain their books of accounts, and a periodic audit is a requirement. Okay, their accounts need to be audited. Fine, they report to the shareholders. They send their audit report to the shareholders, telling them that what the company has done, whether the company is running fine, it is meeting out all the accounting standards or whatever will cover them. Okay, then right of access to information. The shareholders have right to access any information they want. Okay, so since they are not participating in into the business, so they have they are circulated with all the documents like the balance sheet, profit loss, annual report, and other things are given to them, and the auditor report which talks about how the company has done in terms of meeting all the legal obligations. Then types of companies. We must understand various types of companies. First is the government company, the company which is run by government. Okay. Then a foreign company, a company which is run by incorporated outside India but operating in India and doing business, a foreign company. A private company, a company which is run by few individuals, so it can be a private company. And a public company where public is more interested, and which is normally most of the time it gets listed over the time. Now all public company may not be listed, but as the company become more profitable and they need more money, so they can go for listing of the company. Like for example, I was working in a company called Idea Cellular, which was earlier known as Birla Tata AT&T, and in normal, they used to call him Batata, that company. So that was called Birla Tata AT&T, and it was had three shareholders mainly, Birlas, Tatas, and AT&T, and it was incorporated somewhere before 1995, because in 1995 the first telecom business started in India. So then in 2005 or 6, after 7 or 8 years or 10 years, or more than 12 years rather, the company went for an IPO. That means they issued shares to the public, and it became a listed company where the shares were traded in the stock market. So it can be a public limited company, it can be a private limited company, it can be a foreign company, any company coming from abroad and setting up their own business in India. So a government company which is purely run by the government, all the PSUs, Indian Oil Corporation, ONGC, so there the government stake is more than 51%, so they are called government companies. So a government company. Can you read, Mehika? So basically, where almost like more than 51% share is held by the government, or by combination of various governments, central government and state government, or sometimes even a subsidiary of a government company is also called a government company. Okay, is it clear? Okay, yeah. Huh? Oh, I'm not. So we have not started the online. Are there any students still online? What we have started today is, because I'm just going to repeat a bit, you can always watch the recording. So we are going to start a new chapter which is called company accounts. Okay. So we discussed about some features of the company. Okay. Like it's an incorporated association. That means it is registered under the Companies Act 2013. It's called incorporation. Then it has a separate legal entity. Okay. And it has a perpetual existence. That means it will keep continuing the business till it is wound up under the Companies Act. Then it has a common seal where all the documents of the companies can be signed by putting a common seal. It becomes a contract, binding contract between the two parties. Then the company has a limited liability, which means the shareholders, their liability is limited to the extent of the money which they have put into the company. If the company goes become bankrupt, what they can lose is maximum the money which they put into the company. So that's why it's called limited liability. Then the distinction between the ownership and the management. The owners are basically the shareholders, and the management becomes the agents who do business on behalf of the owners, the shareholders. And then, we talked about transferability of shares. The shareholders can always sell their shares and exit from the company whenever they want. Particularly, in case of a company which is listed in the stock exchange, or even a public limited company, then the companies are required to maintain their books of accounts. They have to, get their accounts audited periodically, every year, and even a quarterly audit is also done. Then right of access to the information, the shareholders can, have all the rights with regard to, getting the balance sheet of the company, annual reports, and, they can seek some clarifications of the board of directors, so they have right to access to the information of the company. Now we talked about various types of companies: government company, okay. Then we talked about foreign company, and then a private company and a public limited company. Okay, so these are the various types of companies. I'm going to discuss them one by one. So first is a government. Okay, so we're talking about a government company. Basically, a government company is defined under Section 2 of the Companies Act 2013, where more than 51% of the shares will be held by the government, or even a subsidiary company of a government company is also described as a government company under Section 2. So if the government has 49% share, so the company will go to private company. It will lose its status as a government company. Fine. Anything less than 51%, they will lose the stature of a government company. Fine. Okay. So a foreign company. Yeah, Mika, can you read? According to Section 2, subclause 42 of the Companies Act 2013, foreign company means any company or body incorporated outside India which has placed its India whether by itself or through an agent physically or through electronic mode, and conducts any business activity in India in any other manner. So basically, the company is incorporated outside India. Number one, it is doing business whether by itself or through an agent, physically or through an electronic mode, even if they are present virtually in India and doing business in India. Okay, conducts business activity in India any other manner. So whatever way they are running the business, but they are incorporated outside India, so it will be called a foreign company. Then a private company. So section, yeah.
Section 2, subclause 68 of the Companies Act 2013 defines private company as a company which by its articles restrict the right to transfer its shares, except in case of one-person company, if the number of its members to 200.
So basically, in case of a private company, the transferability of share is not, so easy. It can be done only with proper, process. So it restricts its rights to transfer its shares. So there is two very important documents which company have to, while it gets registered. One is called the Articles of Association, which are the bylaws of the company, and second one is called what? So there are two more main important documents which company needs to file with the registrar of the companies. Okay, one is called the Articles of Association, which is like bylaws of the company. The second is called the Memorandum of Association. Okay, so where all the details of the companies are mentioned. So we'll talk about the Memorandum of Association in detail later on. So they restrict the right. Of course, there is one person company also, but in case of a private limited company, maximum people who can become the shareholders is 200, except the exception is one member company. Okay, fine, one person company. So we'll talk about that. Then public company.
Section 2, subclause 71 of the Companies Act 2013 defines a public company as a company which is not a private company.
So basically, the company which is not private company is called a public company under Section 2 of the Companies Act.
A company which is a listed public company, which is a listed public company, but yet sometimes it continues to be a public company.
Yeah, even if a listed company which gets unlisted by whatever reasons, okay, still it will be called as a public company. Okay, we'll talk about listing. So listed company in India should have at least 75% of the shares held by the public. Okay, fine. So if the shareholding drops below that, then it will be the shares can be delisted. Okay. Okay.
Section 2, subclause 62 of the Companies Act 2013 defines one-person company as a company which has only one person as a member.
So there is another sort of a company which is called one-person company, where you can form a company under Section 2, okay, of the subclause 62, where one person can also form a company. Okay, so this was basically a new introduction which came somewhere around 2010 or 12, 13. Okay, so we'll talk about that later. What's that one-member company? Okay.
Under Section 2, Clause 52 of the Companies Act 2013, listed company means a company which has any of its securities listed on any recognized stock exchange.
So wherever the shares of the company which are listed on the recognized stock exchange, there are two recognized stock exchange. One is called the Bombay Stock Exchange, another is called the National Stock Exchange. So the companies need to get their shares listed either in both of the stock exchanges or any one of them. So if it gets listed, then we say it's a listed company. Okay.
Company whose shares are not listed on any recognized stock exchange is called an unlisted company. An unlisted company can be a public company or a private company.
Okay, so unlisted company can be a private company as well as a public company. I talked about, Birla Tata AT&T, which became now Idea Cellular and now Idea Vodafone. So it was for 10, 12 years, it remained unlisted company where they had not gone for a public issue. Okay. Okay, holding company.
According to Section 2, Clause 46 of the Companies Act 2013, holding company refers to one or more other companies is a company of which such companies are subsidiary companies.
So, the Companies Act defines the holding company in relation to one or more other company means company which such companies are subsidiary companies. So, okay, we'll talk about the subsidiary company, then the definition will become much clearer. Okay.
Section 2, Clause 87 of the Act defines subsidiary company as a company in which the holding company supports the composition of the board of directors or.
So that means the first definition says that the holding company controls the composition of board of directors. That means they can appoint, okay, they can remove the directors. So if they have that power, then the other company will become its subsidiary company. Okay.
Exercises or controls more than one half of the total share capital either in its own or together with one or more of its subsidiary companies.
So if a company holds more than 50% share of another company, 50, or directly or indirectly, either they have invested themselves or its subsidiary company holds and the jointly they hold more than 50%, then the company will be a subsidiary company of that holding company. Okay.
The control over the composition of the subsidiary company and board of director means exercise of some power of the board to remove all or a majority of the directors of the subsidiary company.
So basically, the first controls the composition of board of directors, where the company has power to appoint or remove the board of directors of another company. Then that company is a subsidiary of a holding company. Okay, so this is the definition of a subsidiary company. Okay, and then we suppose go back again and see the definition of holding company according to section 2 of the Companies Act. Holding company in relation to one or more other companies means a company which of which such companies are subsidiary companies. Okay, fine. So now we come to the maintenance of books of accounts. So these companies are supposed to maintain proper books of accounts. So what are given under the Companies Act? Yeah.
As per section 128 of the Act, every company should prepare and keep at its registered office books of accounts and other relevant books and papers and financial statement for every financial year, which give a true and fair review of the state of the affairs of the company.
So all the companies are required to maintain their books of account, okay, at their head office or their registered office, okay, and where they have to maintain all the relevant books, papers, financial documents supporting, even the balance sheet, everything they have to keep at their registered office, and which should give a true and fair view of the state affairs of the company, okay, which means that books should be accurate, and it should fairly reflect the assets and liabilities of the company. Whatever assets they own, they should be owned really by the company. They have the true ownership of the company of those assets, and similarly all the obligation, all the liabilities which the company has towards any other party, that should also be reflected in the books of account as well as in the financial statements. Okay, so it is giving a true and fair view of the state of affairs of the company. Now auditors generally, when they come, so they say that the books are giving true and fair view of the state of affairs of the company, which means they're giving a clean chit to the company when they write this sentence. Okay.
Including that of its branch office or offices, if any, and explain the transactions affecting both every registered office and its branches, and such books should be kept on an accrual basis and according to the double entry system of accounts.
So all these books of accounts, all the vouchers, papers should be maintained. Okay, so the two very important things that the accounts have to be maintained on accrual basis. So this is given under the Companies Act. So they can't maintain their books on cash system of accounting. They have to make the books of account on accrual basis. So the company law says that the books have to be kept on accrual basis. Okay, so no company is allowed to maintain their books on any other basis than accrual basis, and they have to follow a double entry system of accounting, which we are already familiar with. Okay, so earlier there was something called single entry system also, but which has not been there. I mean, mostly very small sole proprietors, sometimes they maintain their books on on a single entry system. So everybody is following a double entry system. That means there will be a debit and credit. There will be always an entry which will be passed, which will have a debit and credit effect to accounts. Okay.
Provided further is a company which keeps such books of accounts and other relevant papers in electronic form in such manner as may be prescribed.
So basically, all the companies need to maintain their books. Earlier, they've been maintained on manual basis. Okay, they used to be, all the paper, this thing, but now everything has moved on electronic form. So, all the companies are following various softwares for maintaining their books of account. So, do you know one or two very big important softwares which have been, and what are they called? And do you know any software, accounting software, which maintains the books of account? World renowned softwares made by Oracle Financials. There's a company called Oracle. Okay, there is SAP. Okay, so these are called ERP softwares. Okay, entrepreneur resource planning softwares. Okay, so they came into sometime about in 2000 or so, or maybe earlier, 1995, 98, 1995 it was they were brought into India. I mean, thereabout. Okay. So Oracle Financial, which was an American software, which was, which many companies started, I mean, maintaining their books of account on those softwares, which was, I mean, made by Oracle Financials. And then there was SAP. Okay. And, in India, we have a tele software, which is almost, maintaining books of accounts on ERP basis. Okay. So these are huge softwares, which, are very user friendly, and it makes the life of, the accountants and other people who want to understand, what's happening in the company. They can just browse those softwares and understand the accounting. So it manages not only the accounting, but manages, whole organization. Fine. For example, the software has the capability that, if you are a manufacturing organization, okay, if your raw material stocks below a certain threshold limit, then it will automatically place an order to your supplier, okay, on a rate which has been already fixed by the management. So it will pick up the rate, pick up the order quantity, and shoot a purchase order to the supplier without the knowledge of anyone. I mean, it will be an automatic sort of thing, okay, so that the company is, running smoothly without, and on a, some companies even, have a payment facility where, the due date is fixed for all the suppliers. So automatically the checks will be printed by the software on the due date. So there is no, and it will be automatically digitally signed. So everything is done basically through the system itself. And all the banks, they maintain their software, which is mostly all the banks are maintaining softwares on a system called Finacle, which is being again through the Oracle Financials. Okay. So these are basically the accounting softwares which now the company needs to, I mean, they can write their books on electronic mode also. Okay.
Under Section 129 of the Companies Act, financial statements should refer to the statement of affairs of the company or companies, comply with the notified accounting standards, and shall be in form or forms that may be provided for different classes of companies as prescribed in Schedule.
So now, what happens is that, Section 129, and there are after many other sections also, they prescribe, that the company have to maintain their books of account, which should give a true and fair picture of the state, the financial, of the company, and they even prescribe, the financial statements, how they are to be supposed to be made. So we'll talk about that.
The board of directors of the company shall make financial statements every annual general meeting of the company.
So once the accounts are being maintained, so every annual general meeting, the board of directors shall present those statements to the shareholders.
Financial statements as per Section 2, Clause 40 of the Companies Act include a balance sheet as at the end of the financial year, a profit loss account or in the case of a company carrying out any activity, not for profit and income expenditure account for the financial year.
So all the companies need to make a balance sheet, a profit loss account. But if you are a non-profit making company, like a club or a religious trust, then they make what? Income and expenditure account. Okay. So whenever we are reading accounts of any cricket club or any, sports club or any, charitable organization, so they will not have a profit loss account, but income and expenditure account. Okay. Whereas all profitable organizations, their statement will be called profit loss account. Okay. Fine. The balance sheet is a common term which is used for both the types of organization.
Cash flow statement for the financial year.
So apart from the profit loss account, balance sheet, income and expenditure, the companies need to maintain a cash flow statement for the financial year. Okay, fine. Where they say what are the various cash inflows and what are the various cash outflows. Okay, of the company. So this is, apart from the balance sheet, profit loss account, they are supposed to maintain a cash flow, because cash flow statement looks to be more a statement which cannot be, tempered with, because it's talking about, opening cash balance and bank balance and the closing balance and where the money has come from, where it has gone. So nobody can, manipulate these accounts. Okay, and this, provides a lot of transparency or to the company in form of, shareholders can always look at the statement and then they can rely on that.
A statement of changes in equity is applicable.
The statement of changes in equity. That means what was the opening, money which was given by the shareholders, how much was further brought by them how much dividends were declared. So this will be a change of statement of equity. What is the the shareholders' money, how it has changed over the year. Okay, fine. So profits will increase the shareholder capital because of reserves. Right. Yeah. So this is a very important thing. Notes to accounts. Okay. So all the companies have to attach certain notes. Okay, which will tell about what kind of accounting policies they are following. If they have to disclose, company is having some legal cases against it. So all the important information, all the disclosures need to be given in the notes of account, and we'll be going into a lot of notes to accounts in our understand when we do company's account. Okay, so notes to accounts is a very important part. So whenever the shareholder is reading the balance sheet profit loss account, he reads the notes to account. Also, it gives more clarity about about various income and expenditure or balance sheet items which are given in these financial statements. It provides some more detail, how the assets have been valued, or how there are any contingent liabilities against the company. Okay, any court cases which are going. So it will give you the latest information with regard to what the management think about those cases and everything. Okay, so we'll visit the note to accounts later on.
As per Section 129 of the Companies Act, the magistrates comply with accounting standards notified by the central government in Financial Times.
So there are accounting standards, they are very important. All the companies need to follow the accounting standards. The accounting standards are generally, there's I mean, in India, they were framed by the Institute of Chartered Accountants. And now, the government recognizes them, and there is an international body also, which are called IFRS. Okay. So all the companies world over, they have to follow the accounting standards. Okay. Now, there are international accounting standards, there are Indian accounting standards. Fine. So all companies are supposed to follow those accounting standards. Now we are gradually migrating to only one accounting standard internationally, so that all companies need to follow them. So that anybody in the world can read the accounts, because there will be no different accounting policies across the world. So everybody has to follow the similar accounting standards. So we are still in the process where we will move towards 100% one single accounting standards. There will be international accounting standards, but at the moment we have a hybrid system, so we'll understand that in our coming slides today itself. So all the accounting standards will be notified by the government of India. Okay, now the accounting standards can be say 100, but government says okay, these are the 50 relevant ones, they should be followed by everyone, so we'll understand that.
Schedule 3 of the Companies Act provides the format of financial statements of companies compliant with accounting standards.
So there is a Schedule 3, okay, which was earlier called Schedule 6 in 1956 Companies Act. So all your financial statements should be made strictly in the manner which has been prescribed under Schedule 3. So we'll look into that. That's very interesting. Okay, and they have to comply with all the accounting standards. So the auditor, once they come, they say that the company has made their accounting books of account as per Schedule 3. So he has to say that, and it complies to all the accounting standard which has been mandated by the government of India. Okay, so once he says that, then the shareholders have a sigh of relief that the company is doing and maintaining all the accounting standard. They're following everything, and otherwise they can qualify the statements. Okay, they can always pass an adverse remark in the audit report, and they'll give some time to see that they follow these standards. But all the companies are strictly they are required to follow. They can't make the balance sheet profit loss account without following the accounting standards. Okay.
Schedule 3 of the Companies Act Schedule 3 of the Companies Act provides general instructions for presentation of financial statements of the company under both accounting standards and Indian accounting standards.
So basically, the Schedule 3 also gives general instructions. Okay, it is a format where the instructions are given. Okay, with respect each and every line item, how it has to be shown in the balance sheet profit loss account. It has a detailed schedule, and all the companies need to follow accounting standards and Indian accounting standards. So accounting standard will be the accounting standard which are international accounting standard and Indian accounting standard. So still we have a system where we have the international accounting standard as well as the Indian accounting standards.
Schedule 3 has parts and they are as follows. Provides the format of financial statements of companies complying with accounting standards.
Okay, so they have three parts. Okay, Division 1.
Division 1 is applicable to companies' financial statements are prepared in accordance with Indian
with accounting standards. So there are certain companies which they have to follow the international accounting standard, and they are called accounting standard itself. Okay, so that is the division one.
Division 2 is applicable to companies' financial statements and prepared in accordance with Indian accounting standards, other than non-banking financial companies.
Okay, so that means, the division two is applicable basically to all the banking companies and non-banking. Sorry, other than non-banking financial companies. So all banks need to follow division two. Okay, fine. Division three.
Division 3 is applicable only to NBFCs which are required to prepare financial statements in accordance with Indian accounting standards.
So all the NBFCs, they need to follow the Indian accounting standard. All the division two is applicable. They have to follow in accordance with the Indian accounting standard. So that means the banking companies as well as the non-banking company, they have to follow the Indian accounting standard. All other companies need to follow the international accounting standards beyond a certain threshold of the turnover. If the company is having, say, 5,000 crores or 3,000, so we'll talk about that later. Okay, all the big companies need to follow international accounting standard. Okay, so this is the form of balance sheet which is given in uh, the schedule itself. Okay, so I'll just open, uh, I'll just share a. So what I've done, I'll just share this Excel sheet also. So this is basically, I'll just share this with you today itself. Okay. Okay, it may take some time for my WhatsApp to open. Okay, so the first part is basically the general instructions. Okay, the first part is general instructions. Okay, it gives you the whole complete general instructions about, and I'll take you through the general, then the balance sheet. Okay, so this is the balance sheet format. So we'll just go through the balance sheet format a little bit. Okay, then I'll share the sheet with you, and then you can go through. Okay, let me see if my okay. So part one is the balance sheet. So name of the company, balance sheet, as at which date, okay. Then rupees in lakhs or thousands. So whatever terminology which you're using. Suppose it's a small balance sheet, then they give you to the ultimate rupee in paisa. But if it is a big balance sheet running into 1,000 crores, so then you can limit it to that the balance sheet is talking about in only in crores or in lakhs, okay. Then it will have the particulars. The first column is particulars. The second column is note number, because there are note to accounts. So if you have made a note to account and you are giving some information with regard to that particulars here, with regard to the share capital or with regard to anything, so that will contain the notes to account. Okay, so that reference will be given here. Then figures at the end of the current reporting period. Fine. So that means the current year. Suppose it is April to 31st of March to 2021-22, which is the current year which is running for most of the organization. All the accounts will get closed on 31st of March. So for this year, the company is going to give you the information with regard to the whole year. Then figures as per the end of the previous reporting period. So that means the previous year numbers are also supposed to be given. So a person who wants reading a balance sheet or a profit loss account, he must know, suppose he wants to know what was the turnover last year, if he's going to the profit loss account, or what is the share capital last year. So he'll have two numbers at same in the balance sheet itself. One for the current year, another for the last year corresponding number. Is it okay? So the item will be first will be equity and liabilities. So it's the liability side of the balance sheet. So equity and liabilities. First will be shareholders fund. How much money the shareholders have brought to the company. Okay. What was any note to accounts relating to this will be coming here. This is for the current year and this will be the previous year. So if there is any change, we'll come to know that if some more money has been brought in by the shareholders. Okay. So share capital. The first column is the share capital itself. So it's giving a broader this thing, some divisions of that. So shareholders fund, will be the first will be share capital. Second will be reserves and surpluses. Okay. That means, all undistributed. Now, reserves and surpluses can come from many sources. One of the biggest sources, all the profits which the company has earned in earlier years, which they have not, shared as dividend with the shareholders. So that money has remained with the company. So that belongs to the shareholders, isn't it? Have you got it? So any profit which the company has earned, the company, out of the profits they declare dividends, but it is not mandatory. The company may not declare dividend if it thinks that it requires money for expanding its own businesses. Okay. So sometimes the company also declare dividend, but still some money is retained back by the company. So that will come under reserves and surpluses. Okay. Now the other source can be, one of the source can be the company has raised an IPO or FPO. IPO is called the initial public offering. The first time when the company raises money to the shares by issuing shares, it's called IPO. Now, if you see all the shares which are being, all the companies which are already in existence, okay, and they want to come up with an IPO, they will come with a,